Welcome to The Explainer. If you're operating commercial trucks, whether that's a single rig you own or a massive fleet you're managing, you already know the margins in this industry are notoriously razor thin. So today, we're unpacking the massive financial hurdles of the job. We're going to break down exactly how the smartest operators manage their cash flow, from the second they acquire a truck to the day they file their taxes.
So let me ask you this. Beyond the diesel, beyond your driver's pay, what does it really cost to keep a rig on the road? Because getting a firm grip on the true operational and financial life cycle of a commercial vehicle is absolutely the difference between running a highly profitable business and having to close your doors.
25 grand. Yep, $25,000. According to industry data, that is the high-end average annual maintenance cost for a single specialized truck driving just 100,000 miles. That breaks down to roughly 25 cents per mile just in repairs and upkeep. When the stakes are literally that high, every single financial decision you make around that asset is absolutely crucial.
Okay, let's dive right into this. We're going to map this out in 5 stages today. 1. Leasing versus buying. 2. Decoding your lease options. 3. Insurance and maintenance costs. 4. Navigating AIC 842 accounting. And finally, maximizing your tax deductions.
All right, Section 1, leasing versus buying. This is really the very first major decision you'll face when you're looking to acquire a new asset.
Let's look at a hypothetical $30,000 truck. If you go with a traditional bank loan, you're financing the entire purchase price plus sales tax. That means you're taking on a $31,800 loan balance. But check out the lease path. Leasing only finances the use or the depreciation of the vehicle. So, if the truck's residual value at the end of your lease is $12,000, you're only financing the $18,000 difference. That translates to significantly lower monthly cash flow requirements, which can easily free up hundreds of dollars a month per truck. And you can pump that money right back into your business.
Moving right along to Section 2, decoding lease options. Because let's be real, leasing is definitely not a one-size-fits-all kind of deal.
You basically have 2 main lanes here. First up is the closed-end lease, which you might hear called a walkaway lease. It gives you super predictable monthly payments, but it comes with really strict mileage caps, usually between 12,000 and 15,000 miles a year. And if you go over, you can get hit with a severe penalty of 15 to 25 cents per mile. Contrast that with the open-end lease. Here, you get a ton of flexibility. You get to determine the residual value at the end of the term. But that flexibility means you take on the risk. If the truck is worth less than the residual value you set when you turn it in, you're the one writing a check for the difference.
Now, what's really interesting about this concept is a standout option in the open-end category called the track lease. TRAC stands for Terminal Rental Adjustment Clause. For commercial lenders and heavy-use operators, this is pretty much the gold standard. Why? Because there are absolutely no wear and tear or mileage restrictions. None. If you're a high-mileage driver putting extreme wear on your rigs, a track lease lets you dial in your monthly payment based on your chosen residual, completely removing the nightmare of those massive end-of-lease mileage penalties.
Okay, Section 3, insurance and maintenance costs. You've got the truck, now let's shift to the daily operational grind and what it costs to actually protect your asset.
Before the rubber even meets the road, you absolutely need customized insurance. Independent operators typically have to buy liability insurance to protect against bodily injury or property damage. If you're leasing, you'll definitely need physical damage coverage to pay for repairs to the asset itself. And depending on your specific operation, you'll likely need to stack medical payments, uninsured motorists coverage, and motor truck cargo insurance to protect the actual materials you're hauling. Now, the cost varies wildly based on your driving history and cargo, but it is an absolute non-negotiable risk mitigator. And getting ahead of maintenance is literally how you prevent a breakdown from completely tanking a month's revenue. Your PMA, or your dry preventative maintenance, happens every 10,000 to 25,000 miles. That includes greasing, fluid checks, and tire pressure monitoring, costing around $100. Then you have your PMB, the wet maintenance, every 25,000 to 50,000 miles. That's your oil and filter change plus a full system inspection, which runs closer to $300. And of course, the mandatory annual DOT inspection is going to set you back about $200.
But hey, those are just the expected costs. Unexpected repairs? That's a whole different beast. An engine overhaul can easily blow past $10,000. Replacing a transmission, $8 grand. Even a new set of premium tires can run over $4,000. And if you run dump trucks, fixing those heavy hydraulic hoist cylinders can cost anywhere from $250 to $3,000. This is exactly why industry experts heavily push operators to create a dedicated maintenance fund.
They recommend setting aside between 7 and 15 cents for every single mile driven, just to brace for those inevitable hits.
Moving into Section 4, Navigating ASC 842 Accounting. It's time to transition from the garage to the back office. How do these physical assets and complex leases actually translate to your corporate books?
You know, GAAP rules recently underwent a massive shift with ASC 8042. Historically, companies could keep certain leases completely off their balance sheets, just kind of hiding them down in the footnotes. Well, not anymore. Today, any lease longer than 12 months must be transparently reported right on the balance sheet. The terminology is key here, though. A right-of-use asset allows you to capitalize an operating lease obligation on the balance sheet without actually reflecting it as standard debt.
So the crucial point is how you actually structure that lease. A finance lease acts a lot like a loan. It shows up as a debt obligation, it features front-loaded interest expenses, and it directly impacts your company's leverage ratios. An operating lease, on the other hand, is listed simply as a lease obligation with a straight-line, highly predictable rent expense. Crucially, it doesn't mess with your leverage ratios. For a CFO trying to manage financial covenants and return on equity, choosing between these two classifications is a massive, high-stakes strategic move.
And finally, Section 5, Maximizing your tax deductions. Let's talk about keeping the money you've worked so hard to make by maximizing your strategy under the 2026 tax codes.
$2,560,000. That is your magic number for the 2026 tax year. That's the maximum deduction limit under Section 179 of the IRS tax code. This rule allows businesses to deduct the full purchase price of qualifying equipment and vehicles in the exact year they're placed into service. It provides massive, immediate tax relief. Of course, the IRS has some strict rules if you want to qualify for this. The vehicle must have a gross vehicle weight rating, or GVWR, of over 6,000 pounds. It has to be used more than 50% of the time strictly for business purposes, and crucially, it must be purchased and actively placed in service by December 31st. Keep in mind, if you're buying a heavy SUV that falls between 6,000 and 14,000 pounds, the IRS caps that specific Section 179 deduction at $31,300.
Let's move on and see how this builds, because recent legislation changes things even more. The 2025 One Big Beautiful Bill Act effectively reinstated and made permanent a 100% bonus depreciation allowance for qualified property. This means that if you max out your Section 179 limits, or if your purchase simply exceeds that threshold, you can apply this bonus depreciation to immediately deduct the rest of the cost of new or used equipment, rather than painfully spreading that depreciation out over several years.
Let's walk through the exact math to see just how brilliantly these two deductions work when you combine them. Let's say your business buys $3 million worth of commercial trucks. First, you apply your Section 179 deduction, maxing it out at $2,560,000. Then you apply the 100% bonus depreciation to the remaining $440,000. That gives you a total first-year deduction of $3 million. If your business is sitting in a 21% tax bracket, that represents an immediate cash savings of $630,000. You have essentially slashed the true cost of your equipment right out of the gate.
Which brings us to our final thought today. Are you truly maximizing your fleet strategy under the 2026 tax codes? Mastering commercial truck finances is way more than just hunting down the cheapest diesel. It's a completely interconnected web of smart leasing, aggressive maintenance, strategic accounting, and utilizing every single tax advantage the law provides. So, take a hard look at your books. Thanks for joining me on this explainer, and I really hope this gives you the tools you need to stay on the road to profitability.